Welcome everybody to this webinar on performance and risk attribution. Today's speakers are Philippe Grégoire, Head of Research and Development at Amindis and also professor at the Louvain School of Management, author of numerous numbers of publications on performance attribution, and myself, Rémi Lehambre, a business engineer at Amindis. So the webinar will last about half an hour. We have planned a little bit of time for questions at the end. You can ask your questions through the webinar page, the GoToWebinar, and we will reply to them at the end of the webinar. So just a first introduction about Amindis for those who don't know who we are. We consider ourselves as pioneer in analytical and portfolio management solutions. We have a mission, provide an innovative solution for analysis and management of investment portfolios. And this mission, we are allowed to do it because we have a deep financial knowledge of complex subjects, and we also have a strong knowledge in IT and other technical stuff. Our clients are mainly asset owners and asset managers. And our software is a flexible software with multiple modules that, depending on whether you're an asset owner or an asset manager, you can choose and pick the modules that you want. For example, our insurance clients, asset owners, pension funds, usually take the portfolio management system and use it with conjunction with the accounting and investment modules, so they have a full front-to-back analysis of their investments. We also have an ESG module, and we cover regulations such as Solvency II, Europe 2, etc. On the right side, with the Amindis asset management modules, usually our clients like to take the performance attribution module, performance risk analytics, and ESG analytics to cover all their analytics. And on top of our software and solutions, we are also experts, and we have different teams that can guide you and help you in the day-to-day work. For example, we have our consultants, our support team. We have also an Amindis Academy, which is led by Philippe Grégoire. He goes to Switzerland, France, Benelux to provide advanced training on performance, risk, attribution, ESG, etc. And just as a sort of introduction, previously Philippe published different methodologies which has gained a lot of success using performance attribution with futures, and also measuring the contribution of ESG strategies, so doing an attribution considering ESG constraints in the investment. So maybe these are publications that you might want to have a look if you're interested. All right, so I'll let the floor to Philippe, who will present his new methodology that has been published in the end of 2025 in the Journal of Performance and Measurement on risk-return attribution.
Okay, so good morning, or good afternoon, or good morning to everyone. So for this presentation, first of all, we addressing different portfolios that are more managed as absolute return portfolio under risk constraint. When I'm talking about risk constraint, I mean that they have a target for volatility. As an example, they cannot have a volatility higher than 10%. And we're not talking about portfolio that are benchmark and where the budget risk is measured by the tracking error. So we stick with portfolio that has constraint on volatility or constraint on different asset classes that modify the risk of the portfolio. So for this presentation today, we start with a quick introduction on return attribution. Then we'll move to a specific topic, which is risk attribution, and then we combine both risk and return to measure the alpha of the different attribution effect. So let's start.
Press the button maybe of this. Yeah, there we go.
Okay, so when we talk about return attribution for this presentation, I will restrain to the Brinson style model. But as you may know, when you measure the attribution effect, mainly you look at the investment decision process. And this investment decision process, we're talking about top-down process. As an example, you may have first an allocation decision, which means that you will allocate the fund under different asset classes, and you may take active decisions, which are overweighting or underweighting holdings against the benchmark. And then within each asset classes or within each segment, you may select different assets than the one that are in the benchmark. Also, if we talk about a fixed income portfolio, a top-down investment strategy may be totally different. First, a choice of duration, then to reach that target of duration, a curve allocation, and then maybe some issuer or credit selection. So what we will see today could apply to different attribution model, return attribution model, but for the sake of simplicity, we will stick with a Brinson style model. So what are the goals for risk return attribution? The first thing, we need to assess the contribution of active management to the level of risk. That will be risk attribution. We will go through a model to understand how we can calculate the impact of, for example, over or underweighting an asset class. What's the impact of that on the total risk of your portfolio? Once we have done that, we have to link the variation of risk to some expected return. We will use, I would say, standard theory for that, and we will refer to topics such as Sharpe ratio or beta, which are under the capital asset pricing model. And finally, once we have Brinson style model, return attribution, when we have risk attribution, when we have the expected return associated to the difference of risk, we can calculate the risk-adjusted active return for allocation and selection, for example, what we will call the alpha for selection, alpha for allocation. Let's go right away to an example to what we want to achieve. Let's take this sector, for example. We have an allocation by sector following some index, and then having that allocation, we see that for this portfolio, he has underweight that asset classes. And given that underweight, a risk attribution model will identify that there is an impact on the risk, which is a decrease of 4 basis points in the risk. That means that you can accept a decrease in return. You can accept -2 basis points in return, and you see that within the Brinson style model, you have 14 basis points. That's why it's in green. The return that you have obtained from this allocation decision is higher than the expected return. But when we look at the red part here, we are on that sector of information technology. We have overweight that sector, 15% instead of 7.7%. And when we look at the return attribution model, it gives you 41 basis points. Is that enough given the increase of risk? When we look at the risk attribution, we see that decision of allocation has increased the risk by 135%. Given that increase, we should expect a return of 54 basis points. That's why this is in red. The alpha is negative. I just realized 41 basis points, I'm expecting 54 basis points. On the other hand, when you look at utilities, this decision of underweighting has decreased the risk by -13 basis points, which means that I can accept a decrease in return. When we look at the return attribution, we see that there is a -1 basis point, which means that this is a negative decision under Brinson, but adding the risk, we see that this is a positive alpha. So what is quite important to understand right now is that risk-return attribution does not replace return attribution. It just gives you some more color on the return that you have realized. Are these returns large enough to cover the variation of risk? So it's really something that you can add to standard return attribution model. So let's have a look now at the methodology. So the methodology, first we start with risk attribution. That model was published in the Journal of Performance Measurement in 2006. I did work with Hervé Van Oppen, that is a COO of Amindis, and that was published in 2006. So in this model, we have proposed a successive portfolio approach to calculate the risk that is associated to active management decision. First type of active management decision, active allocation, which means that you overweight, underweight different segments or asset classes, and then that budget is invested into the benchmark or the index, which is passive in selection. So that difference between that intermediate portfolio and the benchmark gives you the risk effect, the risk allocation effect. And then we go from this intermediate portfolio to the active portfolio today. You keep this active allocation, but instead of investing in the index or the benchmark, you will have an active selection. The difference between the portfolio and that intermediate portfolio will give you the risk selection effect. So let's just have a very quick overview of how we can calculate that allocation, the risk allocation effect, and the risk selection effect. Just a second. Okay, here we go. So for the allocation, so we move from the benchmark to that intermediate portfolio. So the calculation is just here to really understand what are the data that we need. As we can see, I can calculate the volatility of this intermediate portfolio and the volatility of the benchmark. Right, the volatility of the portfolio and the volatility of the benchmark. We have shown that as the weight change over time, weight are not constant over time, the manager can be active every week or even during the day. So we will take different weight, and we have shown that to calculate the risk of the intermediate portfolio or the benchmark or the portfolio, you have to sum the contribution to risk. And the contribution to risk will be the correlation of the contribution to return with the return of the portfolio times the volatility of the contribution of return instead of return itself. And you see here is the intermediate portfolio. Why? Because I'm taking an active allocation, the allocation you see P for portfolio, but investing in a return that is the return of the benchmark. And here you have the benchmark. I take the weight of the benchmark and the return of the benchmark. This difference measures the risk effect associated to active allocation decision. When I look at the selection effect, I go from the intermediate portfolio to the existing portfolio. So I will do the same. I will calculate the difference of volatility. Difference of volatility, as you can see here, I take the portfolio, P active allocation, return P, which means active selection, and I compare to the intermediate portfolio, which is active in allocation and passive in selection. So this calculation, given the data, weight, if we're working on a daily basis, will be weight every day, return for the portfolio, return for the benchmark. That's the data I need for the calculation. So let's have an example now, just to highlight the risk attribution model. Let's assume that we have a portfolio and the client has a very clear target, which is he doesn't want to have too much risk on his capital, which means that the portfolio manager cannot take too much risk. That means that also that the client will look at a benchmark, which may be tricky because the benchmark might be more riskier than the portfolio. So let's say that given that constraint, the portfolio manager decides to underweight stock and overweight bonds. This could be tricky because if the market is going up, it means that that portfolio manager will underperform its benchmark. But that underperformance may be just linked to the difference of risk. That's why risk-return attribution will be important. So let's look at the data. The benchmark volatility is 9.14%. The intermediate portfolio is 8.06%, and the portfolio is 6.78%. So when I look now at the risk attribution model right here in the bottom, I can see that the allocation, the fact that I have underweight stocks, means that I have decreased the risk by minus 2.29%. The fact also that I have selected different securities than the one in the index means that I have increased the risk. As we can see, the risk of the asset class stock for the portfolio is 20.1%, and for the benchmark is 19.2%. So that increase of risk. So that's the risk attribution model that allows me to calculate the allocation effect and the selection effect for risk. And on total, I see that the risk has decreased by 2.31%, which is the difference of risk between the portfolio and the benchmark. Sorry, not 2.24. Okay. So now let's move to risk-return attribution. As I'm able to measure the contribution of active management decision to the level of risk, I need now to link that modification of risk to an expected active return. If I'm able to do that, I will be able to compare the actual return that comes from the active management decision to the expected active return. That's what we call the alpha, exactly the same as the Jensen's alpha. When you look at the Jensen alpha, it is the realized risk premium compared to the expected risk premium given the beta of your portfolio. So here, the alpha of the selection will be the realized selection effect in the Brinson, the return Brinson model, and the expected selection effect that depends on the risk attribution and the link between the risk and the return. For allocation, I will do the same. I will look at the Brinson allocation effect compared to the expected allocation effect, and now I will have the alpha for allocation. Okay, so the link between the risk and the return will be made by the capital asset pricing model. First of all, we have a relation that is always true in finance, which is your expected return depends on the level of risk, which is you have a risk-free rate plus a risk premium. And in theory, try to answer the question, what's the level of the risk premium that you can expect given the risk? So we're looking at asset classes, we're looking at a segment that are, for example, industry or sector. So we can assume that we have a very good diversification. So the risk premium for an asset class I, for a segment I, will be the market risk premium times the beta. And what is interesting to see is that the beta can be written just like this. That means that this is the delta or overweight or underweight in the asset class I, and that's the impact of that overweight or underweight on the risk here of the benchmark, which means this is the risk contribution of an active management decision. And for the beta, it's just like an elasticity is expressed in terms of percentage of the market risk. So if we use that and we put that in the capital asset pricing model showing the Sharpe ratio, we see that the expected return should be the price of risk on the market, which is the Sharpe ratio, times the contribution of that asset class to the risk of the portfolio. So when I will compare to the portfolio, it will be the active contribution. So this is really how we will make the link. The link will be made only by the Sharpe ratio on the market. So let's have a look in some data. We're talking about a market risk premium. And we see here from 2004 to 2024, we see here in black, the black line, you see that's a market risk premium. As we can see, it could be between 6 or 8%, which is kind of stable over the long term. If I look at the volatility here for the VIX, for example, I see that not during crisis, but let's say on a regular basis, it's around, let's say, 15 to 20%, which means that on the market price for risk or the Sharpe ratio should be 0.4 or 0.5. If I now look at some data, I have different asset classes, which are liquidity, Eurobond, international bond, emerging market, international stocks. I see that we have different well-diversified portfolio here, and I see that I have a line, and this line, the slope of this line is a Sharpe ratio. So I see that on real data, the Sharpe ratio is about 0.4%. That's what I will use in this model to calculate the expected return. So as a summary, we have risk attribution that identifies the contribution of asset allocation or any allocation on the risk. I have a return attribution. In this presentation, only Brinson that identifies the contribution of asset allocation, stock picking to the active return. Then through a model here, the Sharpe ratio, I will calculate the expected active return linked to this decision by comparing the realized effect to the expected effect. I will calculate the alpha for allocation and alpha for selection. So let's come back to our example. In this example, as we remember, we have underweight stock and overweight bond. So we have the return for stocks and bond here, for the portfolio, sorry, and the benchmark right here, 12% for the portfolio, 11.7% for the benchmark, which is an active return of 30 basis points. Volatility, as we have seen, the volatility of the portfolio is lower, 6.78%. Volatility of the benchmark, 9.40%. So we see a decrease on volatility by minus 36%. We have seen previously in risk attribution that allocation decision has contributed to a decrease in risk by minus 1.08% and selection by minus 1.20%. So if I calculate now the Brinson model here, given the overweight, underweight in the different asset class and stock picking, I see that the allocation effect, decision of underweighting bond as a negative contribution, overweighting bond as negative contribution, the selection in stocks as a positive contribution, selection in bond a negative contribution. So that's in red, and green when it's positive. Now I add, as I say, I'm not substituting Brinson attribution model. I add another view of the active management decision. That view is introducing introducing risk. So when I look at the stock now, given the decrease of risk, as we have seen a decrease by minus 2.35%, I could allow a decrease in return that is much higher than minus 54 basis points, which means that I have a positive alpha, which will be the same here for the selection in bonds. Selection in bonds has decreased the risk by 2%, which means that I can afford a higher negative return than what I did realize, which means that the alpha is positive. So as you can see, this gives me more color on the return-only attribution. So now let's move maybe in more practical example. This is a real portfolio now, or to calculate that, and what would be the general view of your portfolio. As you can see here, I have the allocation in the portfolio, the allocation in the benchmark, the return of my portfolio, the return of the benchmark. I see that this active return is explained mainly by stock picking. I see that the selection effect here is 3.22%, while the allocation effect, Brinson allocation effect, is minus 0.77%. When I look at the difference of risk, we will see that in a moment. The difference of risk means that I can calculate the expected return associated to this decision given the variation or the change in risk. So what I should expect is a positive effect of 35 basis points, and for stock picking, a positive effect of 3 basis points. One thing that we could note or highlight here that is, interesting, is that in all the portfolio that I have seen, it's mainly the allocation decision that changes the risk profile of the portfolio. Selection decision tends to keep the risk profile constant. So, now let's look at the risk attribution combined with the alpha attribution. So when we see here, we have the volatility of the portfolio, 14.59%, the volatility of the benchmark, 13.65%, right? I see that this difference of risk is explained by allocation effect, 87 basis points, and by a selection effect, the risk allocation effect, and by selection effect, 8 basis points. So the alpha associated to that, the alpha for allocation, given the increased risk and given what I did realize, gives me an alpha that is negative by minus 1.12%, while the alpha of selection is 3.19%. So that complements the return attribution model. So as I said, this type of model is not about tracking error. It's about absolute volatility. It's not relative risk. Here, for example, if we take an absolute return portfolio with volatility targeting, as an example, let's take a European fund with a volatility target of 10%, but at the end of the day, this is targeted against an index. And at the end of the day, the client is looking at the index, at the performance of the index. So mainly if you are in a bull market, right, in that case, stocks will go up and the manager will underperform. So that risk return attribution will explain to the client that, yes, I did underperform, but also on the other hand, the risk was lower. Other example, wealth management, a client prioritizes capital preservation while seeking active management. That's something that we see often. And again, in this case, if you just look at the return could be lower than the index that serves as a reference for the portfolio, but that difference will be explained in the risk return attribution by the reduction of risk. Or if you have portfolio with a budget risk that is not expressed in terms of tracking error, but more in maximum loss drawdown. Once again, this will be a good way to explain the difference of performance. So let's take a look at the takeaway. First of all, we can have different model for return attribution. For this presentation, we remain with Brinson style, but that could apply to fixed income attribution model. For return attribution model, we have the contribution of active management decision to the active return. We have risk attribution model that measure the contribution of active management to the active risk. And by combining return attribution, risk attribution, and a model to express the risk in terms of return, we can calculate the alpha of active allocation decision. Thank you for your listening.
Thank you, Philippe, for this nice presentation. Of course, we're always happy to present new methodologies through webinars, but we are also very happy to meet participants in person. We'll be in Switzerland at the Asset Management Day in the 12th of June. We'll be in Paris at the Institutional Day on the 30th of June. We're from the Benelux region. So we'll be very happy if you want to go further into the discussion, see how these new methodologies can help you in your day-to-day work. We'll be very happy to discuss about it. Please reach out to us if you have any questions. We also offer this academies on different subjects: performance, risk and ratio, performance attribution, ESG. These are sessions with maximum 10 participants that we do in Geneva, Brussels, Paris. It's headed by Philippe, and all the participants that have come in the past have really enjoyed and learned a lot on these different topics. So thank you very much for attending this webinar. If you have any questions, please ask them through the GoToWebinar window. We have time for 3 or 4 questions. Let's see if there are any questions. Okay, first question. So why do you choose the difference in volatility between the portfolio and the benchmark instead of the tracking error?
Good question. Just let's say that you have a portfolio with a risk constraint, as I say, volatility target of 10%. So if you have to manage that portfolio under that volatility target, maybe you will deviate from your benchmark, which means that the tracking error may be high, but you're not looking at the relative risk. You're looking at the absolute risk. And using tracking error will give you a high tracking error for that portfolio, and that won't reflect the risk, while using the difference of volatility will reflect exactly the investment management process.
Okay, I see there an additional question. It's regarding the Sharpe ratio. So you made the link between performance and risk through the Sharpe ratio. Are there any alternatives?
Yes, surely, but as you may know, if you have, let's say, if you use return attribution or risk return attribution for reporting, which means communication to your client, you need to remain quite simple and also use shared knowledge, which is a Sharpe ratio, and keep it simple. If you talk to the portfolio manager, maybe he wants something more sophisticated because he's managing in his portfolio, again, different systematic risk. While Sharpe ratio is only the market risk, he may have like a factor model. So in that case, it may be interesting to talk with the portfolio manager and see what type of systematic risk are price of the market to have the market price for this systematic risk. But at the end of the day, even if you take a factor model or a simple Sharpe ratio, which is a one-factor model, at the end of the day, you will link the risk to an expected return. Okay, one last question I see. Which period and frequency do you recommend for the risk attribution? Yes, as we know, to calculate the volatility, you need a time series. So that time series means that you will need a window and you need a frequency. Usually the frequency will be weekly, using weekly return, not daily, because you have too much noise on daily return. So you may use weekly return and you need a large number of data. The minimum number of data will be 1 year. And as things change over time, I would say that the maximum window would be 3 years. Okay, thank you very much. Thank you for attending our webinar. If you have any additional questions, please reach out to us by email and we'll reply and we'll come back to you as soon as we get your email. We hope you have a very nice day and enjoy your weekend soon. Bye-bye.